Alright guys, welcome back. So in this lesson we're going to be discussing a little bit more of an advanced teaching on fair value gaps. Now I've explained the basics of a fair value gap in the first video that I did. I'll link that up in the corner somewhere. The aim of this lesson is to help you identify high probability fair value gaps and how we can use fair value gaps to help gauge order flow. I'm going to be discussing the anatomy of a fair value gap, and I'm going to be using this piece of price action in front of you to explain a few details that hopefully will help in your trading. Now again, this is not financial advice. I'm just here as an educator. Do not put money that you cannot afford to lose into the markets. Now, there are many things in this chart, but I'm going to try to focus on the salient points for the purpose of this lecture. The first thing I want to draw your attention to is the buy-side liquidity resting above this high has been purged over here. Now, we have buy stops resting above these relative equal highs. When price traveled above these highs, the buy stops became active market participants. Smart money traders will pair sell orders with the buy stops and distribute those positions as the market drops lower to the sell side liquidity resting below these relative equal lows and offload those positions to the sell stops since there are willing sellers below these lows. So essentially, smart money is pairing sell orders with the buy stops in the form of these willing buyers above these relative equal highs and offloading those shorts by buying back from the sellers in the form of the sell stops. This process is known as order pairing and is essentially how the market really moves from buyers to sellers and from sellers back to buyers. Now, why is this important to know? In order for us to have a high probability fair value gap, we need to see a run on stops prior to the fair value gap forming. In this case, we have this sell side imbalance, which becomes a valid fair value gap because prior to the fair value gap forming, we had run liquidity above these highs in the form of buy stops. This also becomes a valid fair value gap because we have broken and closed below this swing low, as you can see over here, thus making this sell side imbalance a high probability fair value gap. So we've seen two conditions met. We've seen a stop run above these highs and we've closed below this swing low. Now, this fair value gap can be divided into a premium for the upper half and a discount for the lower half, separated by the consequent encroachment, which is the midpoint of this sell side imbalance. Now, we can go one step further here, and we can divide each of these premium and discount ranges into two halves again. So we have 4 quadrants inside of this sell side imbalance. The blue shaded area here will be a deep discount, and the red shaded area here will be a deep premium. If you notice inside of this green shaded area, this is where the majority of the consolidation is taking place. If you look at the bodies over here and how price action is being held inside of this green shaded area. If we are bullish, we will get a buy signal that forms in the deep discount or the lower quadrant of this sell side imbalance. And if we are looking for shorts, you can see how we have a sell signal here in the upper quadrant of this sell side imbalance inside of a deep premium. Now, in this case, we have the higher time frame, which is bearish. So we ideally want to look for shorts inside of a premium. Now, if we take this dealing range high to this dealing range low. Now, I do explain dealing ranges in more detail and how they form inside of the ICT Academy, which you can find on my website, theinnercircledragons.com. But for the purposes of this lesson, we have our dealing range high up here, which is our highest high, and we have our dealing range low here, which is our lowest low. Now, if we split this range in half, we have our midpoint or our equilibrium level. Above this equilibrium level, we have our premium range. And below this equilibrium level, we have our discount range. Now, notice how we have dipped above this swing high and wicked inside of the premium relative to this dealing range. Also note the bodies. The bodies are failing to close back above the equilibrium level, and this is indicating weakness. If we look to the left, you can see that we have this small buy side imbalance over here, which is then traded through with sell side delivery, with this candle over here, making this a balanced price range. Now, there are different types of balanced price ranges, and again, that's beyond the scope of this lecture. But since we have buy-side delivery and sell-side delivery, we do not anticipate price to fully rebalance this sell-side imbalance. if we overlap the premium high to the discount low of this sell side imbalance, you can see how the upper quadrant, which is our deep premium, also overlaps with our equilibrium level and the balanced price range to the left. This is holding price here like a brick wall. And again, the story is being told in the candle's bodies. We reject from this area and move sharply away. Inside of this sell side imbalance, we also have a smaller sell side imbalance. Now again, this sell side imbalance can be divided into a premium, a discount, and a consequent encroachment. If you look closely, you can see here the bodies again telling the story. They are failing to close back above the consequent encroachment of this sell side imbalance after we have already seen a rejection from this area. Again, this green line is the consequent encroachment or the midpoint between the premium high and the discount low of this sell side imbalance. Now, if you notice at equilibrium, we have this bearish order block. If we split that range in half, we get the mean threshold delineated with this red line. You can see how that overlaps with the consequent encroachment. And you can see price action, how we've consolidated around that level. And then we've really sold off. When we see a large fair value gap like this, generally I will split it into 4 quarters. And since this is on a higher time frame on the 4 hour, your highest probability key levels will form around the graded range or the quadrants of this sell side imbalance. The key is to look for overlapping levels. The more levels that overlap, the stronger that level will be. And when you align time with these levels, this is where your highest probability setups will form. Now, I could speak another whole hour just on this chart alone. Believe me, there's a lot of information in here. But what I would suggest is go back and back test through your charts. Grade higher time frame fair value gaps into 4 quadrants and then see how prices reacted around these levels on your lower time frames. And this is a great study for you to do. In the words of ICT, I hope you'll find this insightful. If you like more information and an introduction to ICT concepts, I have a free ebook and I will link that in the description below. It's a great resource for people who are new to ICT concepts, although this was a little bit more on advanced teaching. Again, if there are other videos that you would like me to make, please leave a comment in the comment section below and I will do my best to make as many videos as I can for you guys. Again, thank you for watching and take care.